following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. We thank you for joining us today for today's show. We've got an excellent set of topics today. We're going to talk a little bit about investing and overconfidence and the role of a good investment advisor and some other things. So we're glad that you tuned in. Hopefully we'll get some good information to you. We're broadcasting here in New Bern, North Carolina on 94.1 FM WNBU over the airwaves. We can also be seen on Cable TV 10, a local cable channel here in New Bern. And we've got Bob Register doing the engineering for us. We appreciate all his hard work. It's a lot of work. It's a great show that comes out every week, so we appreciate his effort. We also appreciate you all listening and watching. Your comments, your questions. We've got multiple ways to get in touch with me. Of course, you can call us. The phone number is 252-633-0107. If you got any comments or questions, give us a call. We're happy to listen to you. You can also email us directly to the show here. The email to the show is allthingsmoney@dlblain.com. And you could also go to our website, which is www.dlblain.com. And there you'll find information about myself, the show, as well as archive copies of the show. And there's a big Contact Us button you can use to get in touch with us. Okay, so enough for the admin part of the show. I like to start off the show with that, let people know who we are, how they can get in touch with us. For those of you regular listeners, you just have to endure it every week. Anyway, so I want to talk about a couple of things. One common theme that I see all the time coming through my office is investors, and I'll say confusion as to what investing is all about. People seem to think that investing needs to be exciting. You know, there's CNBC and Jim Cramer on TV, and they think that investing needs to be, exciting and adrenaline filled and always, doing something, and that, that picking stocks is what you're supposed to be doing. You're supposed to be out there trying to find the next Apple or the next Google or something like that, and, getting your timing right, and I avoided the bear market of 2000, or I avoided the crash of 87, and bragging about it with friends. I mean, this is what people think investing is all about. And this is, for the most part, people's life savings or their life work, and they sold a company and now they have a nest egg, or they've accumulated it slowly in a 401k, or maybe they're just starting out and it's a college fund for their child. This is not something that should be played around with. This is not something that's exciting, and that all the accumulated wisdom of the investment world, which has really accelerated in the past 10 years or so. It started back in the 50s, guys like Harry Markowitz and William Sharp, Eugene Fama, French, some of these people that came along starting in the 50s to today. The knowledge and wisdom that's been accumulated by the non-sales side, if I can say that, the non-sales side of investors has been tremendous. And the knowledge of asset allocation, risk, diversification, discipline, but yet some people still seem to look at investing as a means to an end rather than, they still seem to see investing as an end of itself rather than a means to an end. And investing is a way to grow your savings. It's a way to accumulate money for a specific goal. It's not a way to make money. A business is a way to make money. A job is a way to make money. But a lot of people approach investing with the wrong mindset, as a trader or something like that. And a lot of that, they're convinced that they have some sort of knowledge that the millions or literally billions of participants around the world do not have, and that somehow they, sitting in their living room on their laptop computer connected to the internet, and that somehow they have some piece of knowledge that is going to outperform, all these other people, that they can consistently build a winning strategy, exploiting some minuscule perceived inequality in the marketplace. And frankly, 20 years ago, maybe it was possible. When we first started investing, when I did years and years ago prior to assisting clients, I used individual stocks, individual bonds, and we did a lot of this. But the past several years, the markets have changed. The information flow is tremendous. The computing power is tremendous. And a lot of the old-fashioned, gumshoe stock picking research and things like that, it flat just doesn't work, especially as your portfolio size gets larger. So a lot of this is driven by overconfidence, and there's numerous studies that point to overconfidence is really, really dangerous in investing. Overconfidence, because people perceive themselves as having powers of foresight that the wider population doesn't. It's just amazing. I sit and I listen to it every day, and people come in and they're naturally concerned about what's going on in the world, but somehow that they know that inflation is going to do X, or they know that interest rates are going to do Y. It's tremendous overconfidence. And the reality is some of those predictions will come true, but it's basically based on luck. There's been numerous studies of overconfidence, both individual investors. There was a recent one here in North Carolina. We have Duke University, so it was done by Duke University, and they got with corporate executives of Fortune 500 companies. People with, even if they don't have true insider knowledge, they have quasi-insider knowledge. They have a lot of knowledge of what's going on with their company. And they made 11,600 forecasts for the S&P 500 over 9 years. So they tracked all these Fortune 500 executives. And what they found was that their estimates of future returns of the market were actually negatively correlated with what happens. And so for all of you out there, correlation is a measure of relationship. So if the executives predicted that the market would go up, on average the market went down. And if they predicted it went down, on average the market went up. That's negative correlation, which by the way is something that we like to see when building a portfolio. That's one of those principles of diversification, is having some assets that go up when others are going down and vice versa. But anyway, it just shows that, and you've heard stories of Wall Street, different hedge fund managers, mutual fund managers. It's very difficult to, quote, beat the market. Well, that's all the time we have for the first segment. When we come back, we'll continue talking about what you, the individual investor, should do with your portfolio.